Imagine waking up to find that your biggest customer has vanished overnight. Not temporarily, not gradually, but completely. That's exactly what happened to America's energy industry in 2025, and honestly, the world barely blinked. Fully loaded oil tankers sat frozen in open water with nowhere to go. Billion-dollar export terminals fell silent. And China, the single largest energy buyer on Earth, simply stopped answering the phone. The alarm didn't ring in boardrooms or government offices. It rang at sea. American energy tankers, packed to capacity with liquefied natural gas and crude oil, came to a dead stop in the middle of the Pacific. Crew members checked navigation systems. Port managers scrambled for answers. But the problem wasn't mechanical. The destination had simply refused delivery. China had closed its doors. Not partially, not selectively, completely. And what makes this moment even more chilling is that nobody seemed to see it coming. Or perhaps more accurately, nobody wanted to believe it could actually happen. For years, the relationship between the United States and China had been built on a simple premise. America produces energy, and China buys it. Massive infrastructure projects were designed around this assumption. Multi-billion-dollar liquefied natural gas terminals sprouted along the Gulf Coast. Pipeline networks expanded. Entire regional economies bet their futures on Chinese demand staying constant. But in 2025, that assumption shattered. Chinese buyers didn't reduce their orders. They didn't negotiate better terms. They simply stopped purchasing American energy altogether. And when U.S. officials and energy executives expected the freeze to be temporary, something far more unsettling became clear. China wasn't coming back. Let's be clear about what this means. We're not talking about a dip in trade volumes or a minor slowdown. Trade didn't shrink, it vanished. The flow of American oil, natural gas, and coal to China didn't taper off over months or years. It dropped to zero in a matter of weeks. Even after diplomatic signals suggested that trade tensions might be easing, the energy shipments never resumed. Chinese refineries and utility companies stayed away, not because American fuel was too expensive, but because it had become something far worse: unreliable. In the energy business, uncertainty is toxic. Long-term contracts are the foundation of the entire industry. Power plants need to know their fuel will arrive. Refineries plan production schedules months in advance. Chemical manufacturers depend on stable supply chains to keep factories running. When political decisions can suddenly halt shipments, reroute tankers, or freeze contracts without warning, the entire system breaks down. And that's exactly what Chinese companies concluded about American energy. It wasn't just a commodity anymore. It was a political risk they could no longer afford to take. So they found alternatives, and they found them fast. The first crack appeared in liquefied natural gas. For years, American LNG had been flowing into Chinese ports at a steady pace. Energy companies on both sides had locked in contracts meant to last decades. These weren't casual agreements. They were carefully negotiated, legally binding commitments worth billions of dollars. But in 2025, those contracts went silent. Chinese imports of American LNG collapsed. Not gradually, but dramatically. Month after month, shipments declined until they stopped entirely. The pause stretched longer than any disruption seen during previous trade conflicts, and it showed no signs of reversing. What triggered the halt? China imposed steep import duties on American natural gas, instantly making it uncompetitive. With the stroke of a pen, U.S. LNG was priced out of the market. But the deeper issue wasn't just cost, it was trust. Major Chinese energy firms had committed to buying American gas for the long term. Those commitments are now frozen. Export facilities along the Texas and Louisiana coasts, built specifically to serve Chinese demand, now sit underutilized. The infrastructure is there, the gas is there. The only thing missing is the buyer. And the losses are staggering. These terminals represent some of the largest energy investments in American history. They were designed to operate at full capacity for decades, generating steady revenue and supporting thousands of jobs. Instead, they're running far below potential, and investors are starting to ask uncomfortable questions about whether that capacity will ever be fully utilized again. Oil told the same story, just on a different timeline. China had been a consistent buyer of American crude for years. Refineries across the country relied on those shipments to blend with domestic and Russian supplies. But within less than 12 months, those imports evaporated. At first, the decline seemed manageable. A modest tariff here, a slight reduction there. But then Russian oil flooded the market at heavily discounted prices, and Chinese refiners had a choice: pay more for American crude that came with political strings attached, or switch to Russian barrels that were cheaper and honestly more predictable. They switched. And well, they didn't look back. By the end of 2025, American oil shipments to China had effectively ceased. Not because the oil wasn't good, not because the logistics didn't work, but because the political environment made it impossible to plan around. Coal followed the exact same trajectory. Monthly shipments that had once totaled tens of millions of dollars dwindled to almost nothing. American coal, which had been a fixture in Chinese ports for years, virtually disappeared. The world's largest coal consumer had quietly removed the United States from its list of approved suppliers. This wasn't a temporary adjustment, it was a structural change, and it sent a clear message. China was willing to accept higher costs and logistical challenges if it meant reducing exposure to American supply chains. Then came ethane, one of the few bright spots in U.S.-China energy trade. American ethane shipments had been growing steadily, feeding China's massive petrochemical industry. Plastics manufacturers, chemical plants, and industrial facilities across the country depended on those imports to keep production lines running. But in 2025, new export licensing rules threw the entire system into chaos. Shipments that were already en route were suddenly frozen at port. Contracts that had seemed secure were now subject to discretionary government approval, and Chinese buyers, already wary of political interference, decided they'd had enough. Industry leaders warned that once energy trade becomes subject to unpredictable regulatory decisions, the damage is irreversible. Trust evaporates, buyers find alternatives, and honestly, they don't come back. China's petrochemical manufacturers are now paying higher prices to source ethane from the Middle East. Profit margins have taken a hit. Production costs have risen. But Beijing appears willing to absorb those losses because the alternative, remaining dependent on American supply, is seen as far more dangerous. The strategy is clear. Short-term pain is acceptable if it buys long-term independence. And that independence is being built methodically. While U.S. exports dried up, China accelerated the development of alternative supply routes that are far less vulnerable to geopolitical pressure. Pipeline gas from Russia and Central Asia continues to expand. Domestic natural gas production is steadily increasing, and renewable energy capacity is growing at a pace that, frankly, few outsiders fully appreciate. The goal isn't just to replace American energy, it's to redesign the entire system so that disruptions from Washington become irrelevant. But the consequences of this separation extend far beyond China. With one of its largest customers gone, total United States energy exports have fallen to their lowest levels in years. Asia and Europe have both scaled back purchases, forcing American producers to sell at discounted prices just to keep volumes moving, and, infrastructure that was built on the assumption of steady Chinese demand is now facing the very real possibility of permanent underutilization. International financial institutions have been unusually blunt in their assessments. If China's pivot away from American energy becomes permanent, large portions of the United States export network could turn into what economists call stranded assets, expensive infrastructure that never generates the returns it was designed for. That's not a minor inconvenience. It's honestly an economic disaster in slow motion. For Beijing, this realignment serves multiple purposes. Energy independence strengthens national security. Diversified supply routes reduce vulnerability to sanctions or trade disputes. And a gradual shift away from fossil fuels aligns with both environmental goals and long-term economic planning. China's emissions have already started to decline as renewable energy capacity expands and energy efficiency improves. Fossil fuel demand is still massive, but it's no longer growing at the pace it once did. And every percentage point of reduction means less dependence on imports, including from the United States. The United States is facing its own contradictions. According to a July 2025 report in the Financial Times, tariffs imposed on Chinese-made solar panels and wind turbine components have driven up costs for American clean energy projects. Just as fossil fuel exports to China are drying up, the United States renewable energy sector is struggling with rising expenses that slow down the very transition it's supposed to be accelerating. The result is a strange paradox. American energy producers lose access to a major buyer, while United States clean energy developers face higher costs for the technology they need. It's a two-sided rupture that leaves both countries worse off. And honestly, energy isn't the only sector caught in the crossfire. Agriculture felt the strain even earlier. In May 2025, the United States Department of Agriculture confirmed that soybean and corn shipments to China were collapsing due to retaliatory tariffs. Energy has now followed the same path, leaving two of America's most important export industries detached from what was once their largest foreign market. The assumption that Chinese demand would remain constant, an assumption that guided billions of dollars in investment, has now been proven wrong twice in a single decade. In Washington, the political fallout has been swift. Representatives from energy-producing states have warned that shrinking exports will translate into lost jobs, declining state revenues, and economic pain for communities that depend on the energy sector. A Reuters report from October 2025 revealed that officials in Texas are deeply concerned that liquefied natural gas terminal projects worth billions of dollars may never operate anywhere near full capacity. Policymakers are being forced to confront an uncomfortable truth. The global energy landscape is changing in ways that fundamentally undermine the assumptions behind those massive investments. Yet despite all of this, financial markets have reacted with surprising calm. In February 2025, Goldman Sachs analysts told Bloomberg that Chinese tariffs were unlikely to significantly disrupt global energy prices. And so far, they've been right. Oil prices have remained stable. LNG markets have stayed within predictable ranges. Volatility has been minimal. But that calmness raises a troubling question. Are American losses simply being absorbed by other buyers? Or are markets failing to recognize a long-term structural shift that hasn't fully registered yet? India offers part of the answer. Reuters reported in October 2025 that Indian purchases of American crude jumped from 175,000 barrels per day to 253,000 barrels per day in just 3 months. Coal imports from the U.S. to India also rose by 12% during the same period. Some of the displaced supply is clearly finding new homes. But the math doesn't add up at scale. India is a growing economy, but it cannot replace China. Diversification can soften the blow, but it cannot eliminate it. Europe faces similar limitations. Bound by aggressive climate commitments, the European Union is reluctant to lock itself into decades-long fossil fuel contracts. American LNG continues to flow into European ports, but volumes are constrained by infrastructure capacity and policy goals. Simply put, Europe cannot absorb what China has abandoned. As the months pass, the break is starting to look less like a pause and more like a permanent shift. The Financial Times reported in August 2025 that Chinese energy companies have relocated procurement teams and decision-making hubs toward Moscow and Tehran. When organizations restructure their internal operations, redirect shipping lanes, and retrain entire trading desks, reversing course becomes extraordinarily difficult. The data paints a stark picture. No American LNG shipments reached China in October. No crude oil followed in November. Coal imports disappeared entirely by mid-year. Each statistic alone might seem temporary, but together they reveal something far more serious: a deep and lasting separation. Supply chains can be rebuilt, but trust and commercial habit are far harder to restore. The issue now goes far beyond trade statistics. If China no longer depends on American energy, what leverage does Washington actually have? And if U.S. export infrastructure was built on the assumption of endless Chinese demand, how much of that investment is now at risk of becoming obsolete? A tanker waiting offshore might look like a brief delay, but if it never docks, if contracts quietly expire and are never renewed, that delay becomes something else entirely. It becomes a symbol, not just of a disruption, but of a fundamental reshaping of global energy flows. The real question is whether 2025 marked a temporary freeze in U.S. energy exports, or the moment the world realized that China could walk away permanently. What makes this shift so unsettling isn't the drama, it's the silence. Prices stayed steady. Markets remained calm. There were no emergency summits or dramatic headlines. And yet beneath that surface calm, an energy relationship that fueled two of the world's largest economies for more than a decade has effectively disappeared. China didn't protest. It didn't negotiate. It simply redesigned its supply system until American fuel became optional, and then it stopped buying. The United States is now left with idle tankers, export terminals built for demand that may never materialize, and a strategic position that suddenly carries less weight than it did before. Because once a buyer rewrites its supply chain, the seller no longer controls the timeline for recovery. That leaves Washington facing a harsh and unavoidable question. If this separation holds, which part of the global energy map slips out of America's reach next?